Welcome back to the channel, everyone. I hope you're all having a great day wherever you're watching from. Today's video is going to be a very important one, especially if you're focused on AI, data centers, and where smart money may be positioning for the next major cycle. We're going to break down a real APLD trade we took this morning, and more importantly, why the data center market still looks deeply undervalued as we move into the next 12 to 18 months of AI-driven growth. This video is for educational and informational purposes only. Nothing discussed here should be considered financial advice or a recommendation to buy or sell any security. All investing and trading involves risk, and you should always do your own research or consult a licensed financial advisor. Is not responsible for any financial decisions you make based on this content. Now, let's set the stage. Even though the broader market has been showing strength, with SPY pushing near all-time highs, today was a reminder that not all sectors move together. While the indexes looked strong on the surface, several growth-focused areas actually experienced notable selling pressure. Defense stocks pulled back, with names like Big Bear down roughly 3%, while Redwire gave back about 6%, following an aggressive 30% rally. Robotics names showed volatility, and the space tech sector also opened the day under pressure. This kind of rotation is completely normal. When markets hit elevated levels, capital often shifts away from one sector and temporarily moves into another. Short-term weakness does not mean long-term weakness, and that distinction is extremely important for investors who want to stay ahead of major trends rather than chase headlines. This morning, instead of focusing on what was red, we focused on what was setting up an opportunity. The data center market caught our attention early, and that's where Applied Digital, trading under the ticker APLD, came into focus. At the open, we saw a sharp dip, creating a high-probability entry window. We entered the trade around the $79 to $80 range on APLX, the leveraged version, with a clearly defined plan and risk management strategy. Our goal was simple and disciplined. Target a 10% move, manage risk aggressively, and let the trade work if momentum confirmed. As the session unfolded, price moved quickly in our favor. We locked in profits near an 8% gain right at market open, taking advantage of volatility rather than reacting emotionally to it. That trade alone demonstrated why preparation matters more than prediction. To give you more context, earlier in the session we watched APLD pull back from roughly 42 down toward the low 30s. That move created a textbook dip buying scenario. Once momentum stabilized, APLX reacted aggressively, giving us a near 16% swing due to the 2x leverage. We captured roughly 10% of that move with disciplined execution, stops in place, and no hesitation. Now, it's important to understand that trading leveraged products like APLX comes with higher risk. That's why we always emphasize having a plan before entering a position. Tools like Prophecy AI help us analyze sector strength, momentum shifts, and risk zones, so decisions are based on data, not emotion. Looking across the broader data center and AI infrastructure space today, we saw strength returning. AMD closed up around 4%, Supermicro gained roughly 3%, and several infrastructure-related names like TSSI, NBIS, and APLD showed signs of recovery. Meanwhile, some miners and speculative names continued to see pressure, which again highlights sector rotation rather than market collapse. Even with rate cuts currently on hold and short-term uncertainty in macro conditions, pullbacks in SPY are normal. What matters is where long-term capital continues to flow. Fundamentally, the data center sector remains one of the strongest structural growth stories in the market today. Despite already taking a solid 10% gain this morning, we still see meaningful upside potential for APLD. From a technical perspective, a move back toward the $43 level is very realistic in the near term, representing roughly 30% upside from current levels. This aligns with the company's long-term trend, which saw APLD climb from nearly $3 to over $42 before the recent pullback. The $30 area continues to act as a critical support zone. It aligns with major moving averages and represents a key level where buyers have consistently stepped in. As long as price holds above that level, the broader bullish structure remains intact. From a long-term standpoint, the AI revolution is not just about software or algorithms. It's about infrastructure. AI requires massive amounts of energy, specialized hardware, advanced cooling systems, and strategically located data centers. This is where Applied Digital truly stands out. APLD focuses on renewable-powered, liquid-cooled AI data centers built close to energy generation sources. That positioning is not accidental. It directly addresses the biggest bottlenecks in AI scalability: power, efficiency, and heat management. The company has established partnerships with industry leaders such as NVIDIA, Supermicro, Dell, Intel, and Hewlett-Packard, which significantly strengthens its credibility and long-term outlook. On top of that, APLD reportedly has a backlog of contracts potentially totaling between $15 and $16 billion, while its market capitalization remains under $10 billion. That kind of imbalance is exactly what long-term investors look for when identifying undervalued infrastructure plays. Financially, the company continues to show strong momentum. Revenue growth is approximately 280% year over year, with the most recent quarter delivering around $126 million in revenue. The balance sheet reflects roughly $5.2 billion in assets, relatively low liabilities, and close to $2 billion in equity. Those numbers matter because they provide flexibility and durability during volatile market conditions. If APLD continues executing on its expansion plans and capitalizing on AI demand, long-term price targets in the $40 to $75 range are not unreasonable. Of course, execution is everything, and no outcome is guaranteed, but the risk-to-reward profile remains compelling as long as the $30 support holds. For now, we'll keep monitoring that key level closely and continue looking for high-probability setups at market open. Volatility creates opportunity, and disciplined traders know how to take advantage of it rather than fear it. If you want access to our daily live trading sessions and see these trades unfold in real time, check out the links below. And if you found value in today's breakdown, make sure to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Thanks for watching, and I'll see you in the next one.